Hey everyone, in today's lesson, we're going to take something that's usually a little bit confusing for people and we're going to make it really simple. We're talking about depreciation and amortization. So by the end of this video, you'll know what these terms actually mean, why we record them, and exactly what your role as a bookkeeper from the moment an asset is purchased to the moment it's sold. I'm going to be walking through this document, Depreciation and Amortization for Bookkeepers, and if you want your own copy, the link is below this video. So what even is depreciation? Depreciation is just the accounting word for the idea that assets lose value over time. So think of things like computers, equipment, vehicles, or furniture. These things wear out, they get older, they become less useful, and they're not worth the same as when they were brand new. Depreciation is simply how we record that natural loss in value over the years, instead of expensing everything the moment it's purchased. Now, amortization is the exact same thing as depreciation, but it's for intangible assets. So these are things that you can't physically touch, but the business will use over multiple years. So think of things like software, trademarks, patents, website development costs. These also lose value or usefulness over time. So we record that gradually as amortization. You'll often hear people use the words depreciation and amortization interchangeably, and that's totally fine. But just know that theoretically, depreciation is for tangible or physical items or assets, and amortization is for intangible or non-physical assets. So why do we even record this? We record depreciation and amortization for three main reasons. The first is to show the asset's actual current value. So a laptop that cost $2,000 2 years ago is not worth $2,000 today. Depreciation will update the balance sheet so that the value shown is actually realistic. Second reason is to spread the cost over the years the business uses the asset. So if something lasts 5 years, it doesn't make sense to expense the entire cost on day one. Depreciation will spread that cost over the time the asset is actually being used. And the last reason is for government and tax compliance. So tax authorities like the CRA if you're in Canada or the IRS if you're in the States require certain assets to be depreciated or amortized. There are rules about which assets qualify, how long they should be depreciated for, and what methods can be used. So depreciation is required. Now you may have heard a term called accumulated depreciation. And accumulated depreciation is just the total amount of depreciation recorded over the life of the asset so far. So every year you record the depreciation expense, and the accumulated depreciation balance also increases. On the balance sheet, you'll always see the asset cost less the accumulated depreciation, and the net of those two always equals your net book value. And you'll see in this example, we have an asset for $2,000, $500 of depreciation has been booked so far. So the net value of this asset sitting on our books is $1,500. So we never reduce the asset's value by touching this first line, the asset cost. We only reduce the value by booking accumulated depreciation. Now, assets are grouped into classes because different types of assets lose value at different speeds. So think of something like a laptop would lose its value a lot faster than a house. And each of these classes has an expected useful life. So basically, how long should it last? So the useful life determines how quickly depreciation is recorded. And if we scroll down here, I have a list of the most commonly used asset classes, a short description, and some examples. So if you buy an asset or your client buys an asset, you can quickly refer to this sheet and make sure you are booking it to the correct class. Now, I just want to point out, as a bookkeeper, you are not required to determine the useful life or the depreciation method. Your job is to simply categorize the asset in the correct class. So now for some depreciation fun facts. So depreciation does not affect cash. This is a really important one. It's not a payment. It's not money leaving the bank. It's simply an accounting entry to reflect the value loss. So sometimes clients misunderstand this. So it's helpful to explain that depreciation has nothing to do with cash. There's also a difference between book depreciation and tax depreciation. There's two sets of rules. So book depreciation is used for financial statements, and tax depreciation is used for tax purposes. So these numbers don't always line up, and that's totally normal. Your accountant will decide the method. And lastly, not every asset depreciates. So things like land or investments or inventory is handled a different way. And then also artwork or collectibles, unless they meet really specific criteria. So these types of assets will stay on the books at their original cost with no depreciation. Now, determining whether something is a repair or an improvement will impact whether something is going to be expensed on the P&L or capitalized on the balance sheet. So a repair is fixing something without extending its life or usefulness. You're essentially getting the asset up and running back to how it was originally running. Something broke, so it's not working, and then it's repaired, and now it's working the way that it was before. So repairs are expensed on the profit and loss statement. Now, improvements are extending the asset's life or usefulness. So the asset is getting upgraded to work better than it was originally before. And so improvements, because they are extending the asset's life or usefulness, we capitalize those on the balance sheet. So we're increasing the value of the asset. Not every purchase will become an asset. So most businesses have a capitalization threshold, something like, let's say the capitalization threshold is $2,000. That means anything that's below the threshold of $2,000, you can expense. And anything above the threshold of $2,000, you can determine whether it should be recorded as an asset. For example, maybe one of your clients is a construction company and they're often buying tools or things for their shop. And let's say they buy a saw for $100. Yes, maybe you could argue that it's an asset, but because of the low value, we're just going to expense it. If you're ever unsure whether something should be capitalized or not, whether it's a repair, whether it's the threshold, you can always just flag it for the accountant. So now let's get into what your role as the bookkeeper actually is when it comes to assets and depreciation. There are 3 triggers when you think about dealing with an asset or depreciation. There's when an asset is purchased, when an asset is sold or disposed of, and at year end. So when an asset is purchased, you are going to categorize the asset to the correct asset class. And then you're going to save any invoice, bill of sale, any relevant information or documentation you have regarding the sale to the transaction. I like saving it to the actual transaction in QuickBooks, so it's really easy to find. And I also like saving it in a folder that I have. It'll be something like Asset Changes 2025, but essentially it'll be a folder that I will use all throughout the year so that when year end comes, I can just give the folder to the accountant. So I'm going to also save this asset purchase in that folder, and that's it. Now, when an asset is sold or disposed, you're going to categorize the proceeds of the sale, and then you're going to do the exact same thing. You're going to save the invoice, bill of sale, any relevant information to the transaction itself and in that year-end folder. What you're not going to do is you're not going to remove the asset from the balance sheet, remove any of the accumulated depreciation, calculate any of the gains or losses on the sale, or create a disposal journal entry. So when an asset is sold partway through the year, there's accumulated depreciation that has accumulated through the first part of the year that haven't been recorded yet. So when the accountant actually records the gain or loss on sale, they're going to have to first calculate the first part of the year's depreciation and then factor that into the calculation. That's why all you're going to do is save the documentation and categorize the proceeds. Now, at year end, you are going to take that folder that you created, that you are adding all the asset purchases and all the asset sales into, and you're going to send that folder to the accountant. So do a quick little check, make sure it has all the new purchases, disposals, any improvements, any other relevant information you think might be good to share, and send it over to the accountant. Once the accountant has completely finished all their year-end calculations, the whole year-end is done, they are going to send you adjusting journal entries. And in that document, there's going to be a bunch of separate journal entries. And one of them will be recording the depreciation for all the assets on the books. So all you're going to do is you're going to enter the journal entry that you're provided exactly how it's shown. It will be really clear. There'll be a note, there'll be a debit, an amount, a credit amount. And all you're doing is re-entering everything that's in that document. Once that's done, you're just going to do a final check. You're going to look at the balance sheet and you're going to look at the accountant's closing financial statements and make sure they match. And that just says that you've entered the adjusting entries correctly, and then you're done. So just to recap, when a tangible asset loses value, we call that depreciation. When an intangible asset loses value, we call that amortization. The total value lost is accumulated depreciation. The asset class is what determines the useful life. Depreciation does not affect cash. There's a difference between tax and book depreciation, but you won't have to worry about any of that. It's more just for your information. Some assets never depreciate, and if something is a repair, you'll expense it, and if something is an improvement, you'll capitalize it or make an asset on the balance sheet. In your role as a bookkeeper, when something is purchased, you're going to categorize it to the correct account and save the supporting documents. When an asset is sold or disposed of, you are going to record the proceeds and save supporting documents. And then at year end, you're going to send that folder to the accountant. And at the end of year end, you are going to enter the adjusting journal entries that the accountant has provided. And that's it. Depreciation and amortization can become complex, but this is all of the information that you as a bookkeeper really need to know. And then the accountant will handle the rest. So now you know what depreciation and amortization means, why we record them, and exactly what to do at every point throughout the year and at the end of the year. And don't forget, if you want a copy of this exact document, it is linked below this video. See you in the next lesson.